Khouw, what's your take here on what happened today?
Well, I think basically the employment data that we're seeing kind of it's kind of like a confirmation of some of the worst fears that I think some people may have had. I mean, we've had a lot of data that's come out that isn't necessarily all that positive. But employment data was basically, it wasn't really sending any alarm bells. But when we look at consumer data, we do see some. And when we see business sentiment, we do see some. And of course, we've had other leading economic indicators that have tipped in the favor of indicating that we might be getting a recession. So when you start to see this, I think we talked about this before, that employment's going to be a lagging number. So I think this is sort of that confirmation. We're getting numbers that are worse than the survey. We have obviously seen some big increases in auto delinquencies. We've seen that credit balances are up, savings are down. We see business surveys that are indicating that there's not a lot of confidence. And this is just one more thing. And we never really know what the tipping point is going to be, but this clearly indicated that it was one of those. The VIX is proving that too.
For an economist kind of guy, Steve, I think had it really spot on in terms of, this is the culmination of a number of things that we saw in the stock market. And this just underscores that notion that perhaps things are much weaker than we think. We've seen, as Mike has said, delinquencies rise. We've seen income levels, all cohorts of income express difficulty in terms of buying and weathering price increases. We've seen the earnings come in light. We've seen the questions around the AI spend. No more blank checks for these companies, Bonawyn. And then we get the jobs report, and it's like, bam, you know what? There it is. Proof that things are slowing.
Listen, I tend to agree in large part with that narrative. I think, however, some of the price action pushes back against that. We saw this, whatever we want to call it, rotation, for lack of a better word, into small caps. But that flies into the face of much of what you just said and what I'm agreeing with and what I also think Mike Khouw just mentioned.
In terms of the move since the beginning of July.
Which is, in terms of this being a confluence of data that's starting to confirm perhaps worst case scenarios. Listen, I do think a lot of the data, first of all, I think there's been a dichotomy between the first and second quarter. The first and second half of the year. You've seen a lot of contradictory data there. What I'm saying is that the employment number today, I think, really pushed people over the edge because just prior to that, you were seeing a massive rotation. I'm with you in terms of the AI spend, CapEx spending concerns around that, but you're seeing a massive rotation into more speculative in terms from a credit quality standpoint in the market. And perhaps you could argue that that was a trade down, but you had to think that the economy was still chugging along at a decent clip if you were willing to take the inherent risk that comes with investing in those type of companies. The reversal today seems to me to suggest that that narrative is now being called into question.
Well, it's sort of, we always hear don't fight the Fed. Mm-hmm. So we got, since Wednesday, I guess it's only 48 hours ago, don't fight the Fed. And boy, they're really fighting the Fed. I would think that I think Monday we probably sell off again, and then I would look to be buying things on Tuesday. I think that I understand the AI story and is that overhyped. Okay, I get that. But then you have a lot of other companies that the valuations have come in a lot. They have great balance sheets. And so to me, I think the backdrop of Fed cutting is not bad, right? Could things go down more? Yes, of course. But I also think that the magnitude of this swing, right? What would it take? Probably not a lot. One data point of better employment,
right, and then
to have everyone just calm down a little bit.
What then? Do these economists reverse their calls for 50 basis points? I mean, there are a number that went up a lot in terms of the number of cuts for the rest of the year. I mean, a couple of them did 2 50 basis point cuts between now and the end of the year.
I think we're based on one data point.
On one data point.
So would it be shocking to see that data point come in a little bit different?
No.
No, really not. So, things seem to get, I don't know, don't panic, I feel like is really the message.
Carter, should we panic based on the charts? I mean, for the week, it's really not been too terrible. S&P is down only 2%.
Well,
it's felt
right.
It's felt awful, though.
When it comes from, that's right. It hasn't been that bad. I mean, to think that the market itself is from its peak down 6.4%, but it's much worse at other aggregations, right? The SOX is down 23 from its peak. The Q's down 12, the tech sector down 15, but the S&P down 6.5 is not that much. The irony, of course, of this is that the surge since April, right, the period where the S&P was trading below 5,000, hit almost 5,700. We're up 15%. Why? Because rates went from 4.75 to 4.1, 4.2. But now, if we should continue that premise, now that we're 3.8, we should rip this market because people know it's not that lower yields equal higher prices like some sort of sacrosanct perfect formula. What we're looking at is the collapse in industrial commodities, copper, zinc, aluminum, and rates plunging. The soft landing narrative is almost preposterous.